Okay, so March 2022, the Federal Reserve raised interest rates by 0.25%. That's it, a quarter of 1%. You probably didn't even notice it in the news. And then, in the next 9 months, the S&P 500 crashed almost 20%. $3 trillion gone. Now here's the thing that should bother you. Apple had record profits that year. Microsoft had record profits. Amazon's revenue hit all-time highs. The companies were fine. And yet, every single one of those stocks collapsed. So what actually happened?
That's what this whole video is about. Because once you understand why this happens, the actual mechanism, you'll never panic sell during a rate hike again. We're going to cover 3 things. 1, what the Fed is actually doing when it raises rates. 2, the exact math that connects a decision in Washington to the value of your ETF. And I promise, it's simpler than it sounds. 3, what this means for you as a long-term investor. Because here's the counterintuitive part. This situation is actually your friend. Let's get into it.
Okay, so what is the Fed? The Federal Reserve is America's central bank, and its most powerful tool is something called the federal funds rate, which is, and I want to be precise here, the interest rate that banks charge each other for overnight loans. Boring, right? Stay with me, because when the Fed raises that rate, every other interest rate in the economy follows. Your mortgage rate, credit card rates, car loans, business loans, they all go up. Now, why does the Fed do this? Simple. When inflation is too high, when prices are rising faster than wages, the Fed raises rates to slow things down. More expensive money means less borrowing. Less borrowing means less spending. Less spending means prices stop rising. It's like tapping the brakes on the economy. But here's the massive side effect they don't tell you about.
Okay, reason number 1, stocks fall. Competition. Before March 2022, if you wanted safe, guaranteed money, like zero risk, a US Treasury bond paid you less than 1% per year. 1%, guaranteed, from the US government, which has never defaulted on its debt in 250 years. Now compare that to stocks, which historically return around 10% per year. You'd pick stocks, right? Easy call. Now fast forward to late 2022. The Fed had been hiking so aggressively that Treasury bonds were now paying 4.5%, guaranteed. Now ask yourself, why would you take the risk of owning stocks, which can drop 20% in a year, when the government is offering you 4.5%, zero risk, guaranteed? That's what's called the risk-free rate, and when it goes up, money flows out of stocks, into bonds. That selling pressure pushes stock prices down, not because anything is wrong with the companies, just because there's a better alternative now.
Okay, here is the part that breaks everyone's brain. And I want you to really get this one, because this is the core of everything. When you buy stock in a company, what are you actually buying? Not today's profits, future profits. Every dollar that company will earn over the next 10, 20, 30 years. You're buying a slice of all of that. But here's the thing. Future money is worth less than money today. If I offer you $100 today or $100 in 10 years, you take it today, right? Because if you took it today and invested it, you'd have more than $100 in 10 years. So the question every investor is constantly asking is, how much is that future dollar worth right now? And that, this is the key, depends entirely on the interest rate. At 1% rates, a promise of $100 in 10 years is worth about $91 today. At 5% rates, that same $100 promise is worth only $61 today. Same promise, same future payout, $30 less just because rates went up. And there's a name for this. It's called the present value discount. Fancy phrase, simple idea. And it applies to every stock on every exchange on the planet.
Now, watch what happens when you apply this to tech stocks, because here's the part that confused everyone in 2022. The Nasdaq, mostly tech companies, fell 33%. The broader S&P 500 only fell 20%. Why did tech get hit so much harder? Think about it. A mature company, like a utility company, makes most of its money now, steady profits year after year. A tech growth company, it might lose money for 5 years before becoming massively profitable in years 10 through 30. Most of its profits are in the future, and we just saw what happens to future money when rates go up. The further those profits are in the future, the more the present value discount destroys them. Growth stocks
are essentially the longest duration investments you can make. Their value lives 20, 30 years out. So when rates rise, they get hit the hardest. It's not that the companies got worse, it's pure math.
Third mechanism, more direct than the other two. When rates go up, companies pay more to borrow money. And almost every large company borrows money to grow, to build factories, hire people, fund acquisitions. If a company was paying 2% on its debt and now has to pay 6%, its profits shrink. Same revenue, same business, just 4% more of it going to the bank. For a company with $10 billion in debt, that's $400 million in extra interest payments every year. Less profit, lower stock price. And this hits you personally too. When your mortgage goes from $1,500 a month to $2,200, you've got $700 less to spend at stores. When consumers spend less, corporate revenues fall. The rate hike ripples through the entire economy.
Now you know all three mechanisms. And in 2022, all three hit simultaneously at maximum intensity. Here's what the Fed actually did. Start of 2022, federal funds rate essentially zero, same as it had been since COVID. Inflation, 7.9%, highest since 1982. The Fed had to act. By July, 2.5%. By December, 4.5%. By July 2023, 5.33%. 5 percentage points in 16 months, the fastest rate hiking cycle in 40 years. The result? S&P 500 down 19.4%, NASDAQ down 33%, bonds down 13%. And that last one? This is wild. The bond market's 2022 was the worst since 1788. That's not a typo. Worse than the Civil War, worse than both world wars.
Okay, here's the part almost nobody tells you. Every investor who stayed in their S&P 500 index fund in 2022 who didn't sell didn't actually lose anything, because paper losses only become real when you sell. And here's what's interesting. Every person making regular contributions, putting money in every month, was actually buying more shares at a 20% discount. That's called dollar cost averaging. And a market crash for a long-term buyer is basically a sale. Warren Buffett said it best. Interest rates are to asset prices what gravity is to matter. Low rates, almost no gravity. Everything floats upward. High rates, things fall to earth. But here's the thing about gravity. It doesn't stop airplanes from flying, and rising rates don't stop long-term investors from building wealth.
And here's what history tells us. Every single time. Every rate hike cycle in American history has eventually ended. The Fed hikes, inflation cools, economy slows, the Fed starts cutting. And when rates fall, everything runs in reverse. Bonds less attractive, stocks more attractive, future profits worth more, stock prices rise. This has repeated for 100 years. In 1980, the Fed raised rates to 20% to kill inflation. The stock market crashed, then boomed for the next 2 decades. Every hike cycle in 1994, 2004, and 2015, the market climbed higher after. And what happened after 2022? By end of 2023, the S&P 500 was up 24% for the year. The investors who held got it all back, then some. The S&P 500 has returned 10% per year on average for the last 100 years, through every rate cycle imaginable.
So what does all this mean for you as an index fund investor? 3 rules. 1. Don't try to time rate cycles. Nobody consistently predicts when the Fed pivots or how the market reacts. Professional hedge fund managers failed in 2022. Your job isn't to outsmart the Fed. Your job is to stay in. 2. If you're making regular contributions, a crash is your friend. You're buying more shares at lower prices. Your future returns actually improve. 3. Your time horizon is your superpower. A brutal year like 2022 barely shows up on a 30-year chart. Zoom in, disaster. Zoom out, speed bump. That's it. Those 3 rules.
Okay, here's the simple version of everything we covered. The Fed raised rates to fight inflation. Higher rates made bonds more attractive. That's competition. Made future earnings worth less today. That's the present value discount. And raised borrowing costs for businesses and consumers. Stock prices fell, not because companies were failing, because of math. Growth stocks got hit hardest. Their profits live furthest in the future. This is exactly what happened in 2022, and it will happen again. But here's what the data tells us.
every single time this has happened in American history, the market recovered, reached new highs. The investors who held came out ahead. Now you know how this works. Hit subscribe if this helped. Every week I break down how money actually works. In plain English, no finance degree required.